If you want to build your career into investment banking, venture capital, or private equity, there's one document that you cannot afford to ignore, and that is term sheet. Every M&A deal or fundraise is decided based upon this particular document. Before valuations are locked in, before lawyers draft long agreements, the term sheet defines how the money comes in, who owns what, and at what valuation. In this video, we are going to understand what actually term sheet is, why is it used in deals, and who actually drafts it. Alongside that, we'll also see the section 1 of this entire term sheet, which is transaction details, and we'll cover every clause that goes under it. This will help us understand the foundation on which the entire deal is built. We have divided this term sheet explanation into two parts, and trust me, it is going to be long because it covers all the necessary details that you need to understand before you step your foot into this industry. If you're someone who's serious about breaking into PE, VC, or IB, then you will have to watch till the end. We leave subscription, comment, or liking the video in your hand, but the only thing that we want from you is your undivided attention. Hey there, my name is Karan Damania. I am an ex-investment banker turned founder, and through Encoding Careers, we help you break into investment banking the right way. So now let's get onto the screen and start understanding details about the term sheet. Alright, so first we are going to start by understanding basics about term sheet, and then we are going to move into detail and understand the clause that the term sheet has in different sections. So for understanding those clauses, we are going to look at this entire template of term sheet, which will help us understand all the legal words that are used in a term sheet, and we are going to understand it simply in our PPT so that we are clear on both the angles. Alright, so starting with the basics, first we have what is a term sheet. So a term sheet is a high level commercial agreement. So understanding it in simple language, a term sheet is a agreement shared between two parties who are engaging into a particular commercial activity. Now these activities are very defined to deal making. So it could be a fundraising, it could be a mergers or acquisition, and that is where this term sheet is sent out by the investor side to the party that is going to get the funding or that is going to get acquired. So what does it include? It summarizes key in terms of an investment before final contracts. So before finalizing upon things and getting the transaction done, this agreement is going to have basic details as to what are the terms on which the party wants to engage with one another. So it acts as a blueprint for definitive documents. So definitive documents are the final version, but to get to those documents, this is going to act as a starting point, right? So in fundraising activity, it is called as term sheet, but when we talk about mergers and acquisition, there it can also be called as letter of intent. The content that both of these documents will have is similar, but the structure, how it is presented, might differ. Talking about letter of intent, it is more like a letter which has a lot of paragraphs. But when we talk about term sheet, we saw over here also that these are mostly in bullet point structure. It is going to set expectation on valuation, ownership, control, and economics. Now all of these things are covered in different section of this entire term sheet, which we are going to definitely cover in the coming slides. For an example, if a venture capital company wants to invest in our company, so they might send out this term sheet which will have basic details about what is the valuation that they are looking out for, what will be the transfer of ownership, so how much dilution will I have to incur so that they get the stake into the company, who will have the control over the company, what are then going to be the economics. All of those things are defined in this term sheet. Basis this, negotiation takes place between the client and the party, and investment bankers are someone who act as an intermediary, making sure that both the parties get the best terms and conditions signed out. So it's mostly non-binding. Over here, non-binding means that this document is not a compulsion to follow, right? It's just a intent that the investors or the acquirer company might be sending out to any company out there. So whatever clauses and everything are mentioned, it does not force that part to accept all of those and go ahead with the document. So as we talked that a venture capital wants to invest in our company, if they mention that the valuation that they are looking out to give us is 50 crores, so it's not necessary that only 50 crore valuation is something that they will give us, because it's non-binding. That means there can be negotiation about these things, and basis that the final documents can be created. It is not necessary that I have to accept all of the terms that are mentioned. The terms can also be removed and new terms can also be added. So it helps all parties align before spending time and money on documentation part. Here the companies are just seeing if they might be able to work together or not. Once they decide that they have to work together, there is a lot of documentation and money spent upon due diligence and other documentation process. So before going on to that, if the terms are not aligning to the client or to the acquiring company, then they might decide that we don't want to waste our time ahead, and this term sheet does not look a good value for them. So that's where they might stop the transaction from going further and save their time as well as the investors or acquirers time. Alright, so why is a term sheet used? So we have discussed most of the points earlier itself. Here we need to understand that negotiation needs a structure. In these kind of high stake deals, the negotiation cannot take over an email or something, because there are a lot of things that have to be taken into consideration. All the terms and conditions are mentioned in this particular document, so that when this single document is signed, that means that everything is agreed between one another. So it avoids ambiguity between founders and investors. It locks key commercial terms early. As mentioned, that term sheet is going to be sent out early in the phase of this entire transaction. There might be definitely negotiation that takes place, but it is going to set some commercial terms early on, that who might be paying for all of these processes, who might be taking charge of due diligence, what is the range in which the valuation might be given, and basis that the decisions can be made. Alongside that, it reduces friction during legal drafting. So when the final documents are created, these entire term sheet can be taken as a reference, and it saves time during due diligence and closing. Here you need to think of it as agreement of on intent before agreement on paper. So this means that if you are running a company and someone is sending out you a term sheet, that means they are intending to do a transaction with you. They have not yet finalized things on their side. You are not finalizing things on your side. You just are considering and making decision whether to go ahead with it or not. After you make a decision, then there are a lot of agreements that are done on paper. So coming to the third slide, we have who creates this term sheet. So it is primarily drafted by lawyers and guided by investors. Taking the earlier example, that a venture capital firm wants to acquire our company, are then going to reach out to their lawyers, mentioning that this is the company that we are looking out to acquire. We want term sheet to be drafted out. Then they are going to send it to us, right? So their lawyers know what legal language has to be used in these kind of documents, and basis that they will draft the first version, including all the commercial terms that have been discussed between founders and investors. So before drafting the term sheet also, there are a lot of discussions between the investors and the founders that take place. So term sheet comes into the process few steps down the line. Earlier, when the deal process starts, if a startup comes to an investment banker for raising their funds, the investment banker will first make them investor ready by creating their pitch deck, models, and doing a lot of research around valuation and everything. Then they are going to start with the road shows. Now during the road shows, they will reach out to a lot of venture capital companies. They are going to reach out to institutional investors, whoever might be the best fit for that particular startup. And then when some of the investors might say that yeah, we want to understand more about this particular startup or a particular company, then there might be discussion between investment bankers, the founders, and the investors during a particular meeting. They might discuss about what is the requirement of the business, then the valuation range that the clients and investment bankers might have in their mind. And after having those 2 or 3 meetings, the investors might send out this first version of term sheet. Until then, investors know a lot about this particular company, and that's where they can mention terms and condition into term sheet depending upon the discussions. That is how we understood how term sheet comes into the picture. After that, term sheet is sent by investors, which is drafted by their lawyers. The investment bankers and the client will both look at the terms that are covered in this term sheet and see if that is aligning with the valuation that they had in mind, with the structure, the rights that they have to give. Most probably the discussion take place around some of the key terms like valuation, what is the exact mechanism that is used, how is the investor going to be paid, if there is any royalty involved, how much rights are the investors getting. So all of these are some of the key terms that are noted by investment bankers and the clients, and negotiation mostly takes place across those. So the final language is refined jointly. So once investment bankers, clients look into this term sheet sent out by the investors, they are going to then send out their input. If anything is looking misaligned, then discussions might take place around that. So lawyers draft it, but business logic drives it. Here the client is going to look into the term sheet from a future perspective. Taking an example of valuation, if the valuation that our company is currently getting 50 crore and the amount that we are raising is around 25 crore, we will have to dilute around 33% of the company if the post money valuation comes around 75 odd crores. Taking into the account, if we want to raise further also, like 2 years, 3 years down the line, and the amount might be bigger in size, so that's where we will have to dilute more going down the line. So the logic that you have around your business planning down the line will be driving your further negotiations on the term sheet. So hope this example gives you a rough idea how the negotiation take place and what actually term sheet is used for. So now we are going to move on to the section 1 of this entire term sheet, which is transaction details. Here we can see that this is a draft term sheet. Lot of details coming from the lawyer side in this yellow highlighted dots. Also there is information that changes across this green highlighted text. We are going to understand these clauses first in the presentation in a simple language, and then we will see how this legal language is used in this draft term sheet. So clause number 1 is around business, and it covers what business is the company in. when the investors are meeting investment bankers and the client, they know what the business is. So here this is very basic in what business the client is, right? So here the brief description of a company's core operation is given. Then it defines the scope of activity investors are funding, and it helps avoid disputes on diversification later. Here this is going to be very important. So for an example, if a venture capital company is funding us and we are into business of, if we are in the business of education, doing online programs to help people get started, and that is our core operation, in this business section it is going to be mentioned that the investors are going to fund us for expanding this core operation, that is this education line, and we will have to use funds for that purpose only. And down the line, if we think that this entire core operation is not working well, then we cannot diversify without having discussed with the investors, and that is definitely going to help avoid disputes that might come in, because investors would say that we funded you to carry on your business in this particular operation, and now you are using funds for something else. This is not going to work out. So this anchors the deal to a specific business model, right? So that is going to be clause number 1. So the detail of that is going to be mentioned over here. The company is currently engaged in the business of, in place of this yellow highlighted dot, there will be details that are mentioned around what the client's business is and what the investors are funding. Next we have clause number 1.2, which is promoters. So this clause in the term sheet mentions who controls the company today. So here details of the list of founders or the promoters that are there in the company is mentioned. Then it establishes accountability and ownership. So this helps all the parties involved in the transaction to know how much percentage ownership one has, and when the dilution will occur, how much is going to be diluted from each of the promoters involved. It is also very important for government. It is also very important for governance and lock-in clause later. We will understand both of these clauses down the line. Here very important point that we have mentioned is investor back people first, business second. Why this is important is getting to understand who controls the company is very important. For an example, there is a 15 years experienced CEO that is running particular company, and the investors that are putting money into the company are going to back that particular CEO who has that 15 years of experience, who knows how the entire industry works, who knows how to set up operation, how to hire people and everything. If that particular person does not hold a stake in the company, the investors might give a second thought to investing in that particular company, because if CEO does not want to work tomorrow, he might quit the company easily because he does not have any stake into the company, right? So that is where the investors see that people that are running the company, do they have stake in it, so that it shows their dedication and they are disciplined in running the company down the line, right? Because investors are not putting in money for what the company's value is today. They are seeing the potential of how much the company would be valued 5 years or 10 years down the line. They are definitely backing people first and business second. Going back to the term sheet over here in the promoters, this is clause number 1.2. Here it will be mentioned the company is currently controlled by dot. Here the list of the promoters will be coming in, and what is their ownership, the entire table will be mentioned over there. So that takes care of clause number 1.2. Next we have clause number 1.3, which is current capital structure. So this clause mainly covers what does ownership look like today. So here number of equity and preference shares that are issued in the company, the face value per share, the existing shareholding pattern, and there will be schedules reference for detailed clarity on this. This is going to act as a base before any dilution happens. So here giving example, when a company gets started, there are 10,000 shares that are issued, and these are normal equity shares. When a new investor comes in, they might go for a preference share, or they might go for a convertible debentures. So that is what the investors want to look like. How much do we have in normal equity, how much do we have in preference, and how much do we have in convertible, because every different type of instrument that is used in capital structure has different level of rights associated with it. So preference shares are more preferred than the equity. So when in case of the company shutting down, the preference is given to the preference shareholders, and first money is going to be paid to them and then finally to equity. And above preference are the convertible debenture holders who have more rights than the preference. So first the money is paid to them, then to preference, and finally to the equity holder, normal equity holders. The investors want to look into this as to what is the current capital structure. Then the face value per share. So most of the time when you are creating new company, it is going to be private limited, and face value per share will be mostly 10, right? And then when you want to split the shares and reduce our share price, then the face value might split. That comes down the line. So initially when you start the company, the shareholding might be distributed 100% between the founders or co-founders and the promoters who are putting in the money. After you raise first round of funding, new investors might come in and co-founders might have to dilute their shareholding. So the investors or the venture capital people would be looking like how much does the investor hold, how much do co-founders have as of now. So this gives them clarity as to how much disciplined will the founders be in the company. If they have higher stake then there will be more discipline from their side. Then there is schedule reference. So detailed schedule is given and it is kind of a table which gives clarity. So coming back to the template, this is current capital structure. So a detailed paid up value is given and how much issued share capital is. So these are all the legal terms that are used. Face value of INR, mostly this will be 10 per share, and preference will be also 10 per share. The promoters hold how much percent, so this will be given over here. And finally the shareholding pattern of company effective date is set forth in schedule 1. So a detailed schedule 1 is given. This is going to be linked with a table, and there the shareholding pattern will be given, like founder 1 having 50% of equity, founder 2 having 30%, investor 1 having 20%. So detailed names will be given of these particular parties. Next we move on to clause number 1.4, that is instrument. Now we are moving on the side of the transaction. So here we will understand what security is investor buying. So as mentioned, here we have equity shares, preference shares, CCDs. Then in this clause, rights are also determined, the voting, dividends, liquidation. This is very critical for risk return profile. So as mentioned in the previous clause, we saw CCDs, which is debt securities, have higher preference. Then there is preference shares, and then there is equity rights. So the client that is working with the investors might say that we are happy to give you convertible debentures as of now, which has more preference than normal equity if you invest in the early stage of company, where they are definitely taking risk and investing in you. The investor might be happy to put in money if you are giving them a higher preference, something goes sideways. Alongside that, different securities might have different kind of rights related to voting, dividends and liquidation. So that is something that we are not going to look into detail. We just want to understand the clauses that are covered into the term sheet. When you work on different deals, you will understand this in more detail, and there are a lot of resources out there. So if you want, you can download the entire term sheet template via link in the description, and you can search different clauses in detail, and you might understand what each type of instrument means. So instrument choice defines investors protection. That is definitely understood from the above 3 points. So coming back to the template over here, as this is the mock template, here only equity shares having a face value of INR dot, and each price that dot is given. It will depend totally upon different kind of transaction what is going to be taken up by the investors. So here it is mentioned, definitive documentation shall have the meaning ascribed to it under clause 3.1 of this term sheet. This we are going to look in the next video, where we will cover section number 3 of this entire term sheet. Definitive means the final version will have detailed meaning attached to it, rights attached to this particular instrument, and what type of product is exactly used. So that is going to be clause number 4 of section number 1. And now we are going to look at one of the most important clause number 1.5, valuation. So at what value is the company being invested into? Mostly pre-money valuation is stated over here. Having this clause helps us understand how much dilution is going to occur. It is the foundation for ownership and returns that the investors might make down the line, and it is one of the most negotiated clauses in the term sheet. There are a lot of deals that fail on this particular clause itself. Sometimes it might happen that the investors are valuing too low a company, and client sees themselves as more valuable. So a recent deal that failed across this particular term was deal between an academy and Upgrad, where Upgrad wanted to acquire an academy. So an academy pitched themselves around 2 billion of valuation, and Upgrad was not willing to give them that level of valuation. So the deal got off due to the misalignment between this. Looking at our template over here, for the purpose of proposed transaction, the pre-money valuation of the company is INR dot. So here a detailed amount would be given, basis which the dilution will be taken into consideration. Now talking about the example that we have taken of a venture capital company investing into our business. So let's assume that they have given a pre-money valuation of 50 crores, and we are raising 25 crores of money. So the post-money valuation will become 75 crores, and the dilution that might incur will be 25 upon post-money valuation, which is investment upon the post money, and that becomes 25 upon 75, that is 33%. All of those detail will come in once the valuation is decided upon, and that will help us understand how much dilution is going to occur. So in our example, 33.3% was the dilution, and now the investors are coming in at a 75 crores of post money valuation. It is written that it is foundation for ownership and returns. So they are getting 33.33% as ownership. Majority of ownership remains in our hand. We have the capacity to make decisions and take actions into the company. If someone is diluting more than 50%, then the control rights mostly shift to the party that is acquiring more than 50 percentage, and then they can make the decision into operation of the business. Talking about the returns part, since they are coming at 75 crore of valuation, they are looking that in the next 5 to 10 years the company will grow beyond 75 crores in valuation, so that they make a positive return. So it's not like they are looking at a 100 crore or 120 crore valuation. When a venture capital puts in money into any particular business, they are looking minimum at a 10x 20x return. So they might see that in the next 5 to 7 years we become a 500 or 700 crore company. So that is the math behind their investment amount. That is where they mostly want to value a company at a lower valuation, so they have more space for making their returns when they go for the next round of funding, right? So hope this clause clears, and it is going to be most important to understand when you enter into this deal making business. Next we have clause number 1.6, that is proposed transaction. In this clause we are going to understand how much money is coming in and how. So this covers the investment amount, the post money shareholding structure, flexibility to revise before definitive documents, and the timeline for closing. So this clause is operationalizing the entire deal. From clauses 1.4 to 1.7, these are very important. We saw that earlier clauses were mostly related to what the company is as of now, and now we are mostly moving on the transaction side. Here the amount of investment is going to be mentioned. So taking our example once again, the investment amount is 25 crores. The post money shareholding will be 33.33 held by the investor, 66.67 held by the promoters of the company. And the third point is very important, that it has flexibility to revise before definitive documents. Now definitive are the finalized version. There is definitely flexibility that if the clients think that the valuation should be higher than 50 crores, the investment bankers might pitch it to the venture capital people that we think that the valuation should be much more higher than 50 crores. They will definitely have a lot of reasons with them. They will research previous transactions that have happened in this particular industry. They will build out DCF models, and basis that they will have the logical conversation with the investors. On all those lines there will be flexibility, so that the client is happy that they are doing less dilution, and the investor is also okay to raise up the valuation a bit, defined by the investment bankers logic. And finally there will be timeline for closings. It might be mentioned that this document is operational for next 6 months or so. Coming back to our template, here there is a lot of detail that is given in this proposed transaction. So subject to applicable law, the investor proposes to make an investment up to, so this dot will have the investment amount, so it is given over here, will make an investment up to. So in our case, let's assume it's 25 crores. So company such that post investment shareholding pattern shall be manner set out in schedule 2. So there will be a schedule given at the end of the term sheet, which will give the post shareholding pattern. So in our case, the promoters will hold 66.67 and the investors will get 33.33 if they agree on the 50 crore valuation. And also it is mentioned that the investment amount may be subjected to change anytime subsequent to execution of this term sheet of the definitive documentation. This was covered in the third point, that it has flexibility to revise. The parties will work towards achieving completion of proposed transaction, but not limited to remittance of investment amount of issue of corresponding share within the time frame specified in SS. So this is shareholders agreement, which is also shared along with this term sheet and has a lot of details on the timeline and everything. So the shareholding pattern immediately closing shall be set forth in schedule 2. So these two schedules are the same, and if the investment closes at this particular valuation and investment amount, it will be as per schedule number 2. So that clears clause number 1.6, which was second last. And the last clause that we have in the transaction details section is clause number 1.7, advisory equity. So are there any advisors being compensated in equity when this transaction goes through? So here equity issued for advisors or mentoring services have to be mentioned. It is an optional clause, like not every deal will have these kind of clauses, because there might not be an investors or mentoring services that the client might have taken, and due to this there will be careful dilution consideration, because the advisors are not going to put any money into the business. This clause is very common in early stage and strategic advisory deals. For an example, if there is an investment banker that deals only in early stage investments, they will not take up money for making them investor ready. They might say that you will give us equity in your company and we will help you get funding from the investors that we have in our network. The investment bankers will help them facilitate this transaction. They will connect them with the investors. They will do all the roadshows and everything, and in exchange of the entire fees that the investment bankers might have made from this transaction, they are taking the equity in the company. So this equity might be in range of 0.2, 0.5 to 1%, depending upon what is being negotiated between the startup and the bankers. Or also there will be strategic advisors who might get on board. For an example, since we are in education business, we need to do a lot of tie-up with colleges out there. So people who have been in this entire industry and have a lot of types with the college. We might reach out to them that we have this particular business, this is our product and services that we have, and we need to tie up with colleges to help them build career in finance. So they might be happy to share their network and leverage it to us. In exchange, we might give a strategic equity into the company, so that when we grow, they also get value from the business. They can sell out this equity to any investors they want, and they can capitalize upon it. So that is how advisory equity works. This is the final clause of our section 1, which is transaction details. This is clause 1.7, and the company agrees to issue at the time of closing to here the name will come in equity shares or equivalent to dot percentage of dot in value in consideration of advisory and mentoring services rendered by XYZ on an ongoing basis, subject to terms set forth in definitive documentation. So a lot of terms will be set forth in the definitive documentation, like how much hours are these advisors going to give us in exchange of this equity, how much value are they going to provide us, how much network are they going to leverage to us. So all of those details are mentioned, and basis that a value is calculated, and for that value equity is given to the advisors. So that takes care of the entire transaction details section of the term sheet. Alright, so the section 1 that we have covered is going to set the structure for the deal, but here lot of necessary details that are going to go into term sheets are not covered. In the second part of this video, we are going to cover the next 3 sections that go into the term sheet, which is going to help us understand on what points will the negotiation take place. So continue watching the second part to understand the term sheet in detail. So that is it for this video. Until then, this is Karan Damania taking your leave.